something broke quietly before Davos even began. Treasury demand didn't disappear. It hesitated. Orders that usually clear without friction stalled just long enough to matter. While Donald Trump spoke about strength and leverage, investors weren't listening. They were adjusting exposure, shortening duration, redirecting flows. Nothing dramatic happened on the surface, which is why it was dangerous. Europe didn't argue. Canada didn't respond. China didn't threaten. The shift was already mechanical. When capital stops behaving on schedule, it's not reacting to policy. It's withdrawing trust. And once that happens, power doesn't collapse. It relocates. It was only January, barely the start of the year, and yet Davos had already turned into something volatile. Trump's speech stunned the room. He demanded Greenland again, repeatedly confusing it with Iceland, invoked World War II in a way that left delegates frozen, and warned that without American intervention, parts of Europe would be speaking German or Japanese. At one point, he blamed Iceland for a past United States market collapse. Reporters in the hall later told the Financial Times the moment felt unreal, as if policy and improvisation had merged. Trump then pivoted to the economy. He declared that grocery prices, energy costs, airfares, rents, mortgage rates, and car payments were all falling fast, insisting the United States had fixed the mess it inherited in just 12 months. Yet, at the same moment, Bloomberg data showed global investors moving the other way. The dollar was weakening, equities were rolling over, and United States bonds were being sold. What happened next mattered more than the speech itself. Trump backed down. There would be no mobilization to seize Greenland by force. The additional 10% tariffs on European Union goods scheduled for the following week were suddenly postponed. Europe could breathe, briefly. In their place came a new framework involving NATO and Greenland. Still a takeover in substance, but dressed in procedure rather than threat. Military presence could increase. Mineral rights would be discussed. Trump even said the arrangement could last forever. Behind the scenes, officials understood how hollow that claim was. Developing a viable mining sector in Greenland would require well over $1 trillion and decades of investment. The ice sheets alone make extraction a generational project. NATO's strategy, according to diplomats quoted by Reuters, appeared focused on delay, stretching the issue long enough to outlast the current presidency. The real question was not Greenland, it was why Trump retreated so fast. The answer was flashing on trading screens. Within an hour of the U.S. market opening, the Nasdaq fell more than 1.5%. Technology stocks were imploding, dragging household wealth with them. This was not a normal correction. Bank stocks dropped alongside growth names. According to Reuters, J.P. Morgan slid sharply, a signal that markets were expressing fear rather than rotation. At the same time, the 10-year Treasury yield surged above 4.3% before settling near 4.28. Traders immediately recognized the pattern. This was a replay of the Liberation Day collapse. When yields spike while stocks fall and the dollar weakens, Washington loses room to maneuver. Trump's economic agenda depends on borrowing. Semiconductor fabs, AI data centers, reshoring initiatives, none of them work with rising financing costs. The Wall Street Journal has reported that U.S. technology companies are already taking extraordinary risks, pouring capital into AI infrastructure without guaranteed demand. Higher yields turn those risks into potential failures. The U.S. economy is now inverted. Stocks don't follow growth. Growth follows stocks. If equities keep falling, spending contracts. If spending contracts, GDP falters, regardless of deficit spending. Construction data underscore the fragility. According to U.S. Census figures cited by Bloomberg, only data center construction is expanding. Residential projects are declining. Commercial real estate is stagnating. Manufacturing outside subsidized sectors remains weak. AI spending is holding the system together. Strip it out, and the private economy would already be contracting. That is the leash Washington is on. Threaten the world too aggressively, and the bond market tightens it. Davos exposed this reality in public. And it wasn't just Trump. Scott Bessent was present. Howard Lutnick was there too. Lutnick's intervention stunned European delegates even more than Trump's speech. Standing before the EU, Lutnick warned Europe not to depend on China. He urged them not to hollow out their industrial base, not to offshore medicine, semiconductors, or core manufacturing. Sovereignty, he said, required domestic production. Then came the contradiction. If Europe had to depend on someone, he argued, it should be the United States. The room reacted instantly. Journalists described disbelief spreading across the panel. Europe has spent years under pressure from Washington to relocate factories, energy purchases, and capital flows to the U.S. Now it was being told not to offshore, except to America. The exchange devolved into interruptions and heckling. According to Bloomberg, even European Central Bank President Christine Lagarde left a Davos dinner early as the scolding continued. Lagarde's departure carried weight. She does not gesture lightly. Shortly after, she delivered remarks that cut through the noise. Europe, she said, must deeply revise how it organizes its economy and how it builds ties with other countries that play by the same rules. The Financial Times reported that EU officials interpreted this as a warning that dependence on the U.S. model had become a liability. The shift was no longer theoretical. Europe began moving in the same direction as Canada. Trump made that easier with another remark. Speaking about Canada, he warned there were consequences for moving away from the United States. He accused Canada of ingratitude, singled out Prime Minister Mark Carney, and implied that Canadian prosperity existed only because of U.S. protection. Reuters described the comment as one of the most openly coercive moments of the summit. The effect was immediate. Europe froze negotiations on a U.S. trade deal. Officials said the pause was temporary, but exporters felt it instantly. Roughly 20% of U.S. exports go to the EU. Delays alone raise costs and uncertainty at a moment when financing is already tightening. More damaging was what followed in financial markets. European funds began reducing exposure to U.S. Treasuries, not with a single announcement, but through steady withdrawals. Bloomberg reported that multiple institutional investors had paused new Treasury purchases, citing instability and policy unpredictability. One case stood out. Sweden's largest pension fund confirmed it had sold its entire U.S. Treasury holdings, more than $10 billion, beginning in 2025. The justification was blunt volatile U.S. policy, expanding deficits, and rising inflation risk. This calculation is spreading. If the U.S. faces fiscal stress, it will not cut domestic spending to protect foreign bondholders. It will monetize. IMF analysis has repeatedly warned that inflation is the cleanest way to transfer losses. Bondholders receive dollars. Those dollars buy less. Nominal obligations are honored. Real value disappears. That risk is no longer theoretical. It is being priced. This is why Europe has begun exploring alternatives. Chinese RMB-denominated bonds issued through Europe's own financial infrastructure are gaining attention. These instruments, known as yuan bonds, are issued by Chinese entities in yuan and cleared through Euroclear. Reuters reported that issuance has been rising steadily since 2023. The appeal is practical. Beijing has not weaponized its bond market. Payments have been honored, and over the past year, the yuan has gained roughly 4% against the dollar, according to exchange data cited by the Financial Times. Demand remains modest, around $1.2 billion last year, but the trajectory matters. Pension funds, insurers, and wealth managers now have an option that does not depend on U.S. political stability. Each issuance expands the yuan's international circulation. Each settlement reduces reliance on treasuries. China benefits quietly. This is not a headline takeover. It is a structural drift. As dollar policy grows more volatile, alternatives gain legitimacy. Investors are not making ideological statements. They are managing risk. That is why Trump's Greenland retreat mattered. It was not diplomacy. It was enforcement by markets. When yields rise, stocks fall, and the dollar weakens at the same time, power compresses. Threatening allies while relying on them to finance deficits stops working. Davos made that visible. As Trump recalibrated his tone, capital recalibrated its allocations. Treasury demand softened. RMB demand rose. Europe paused. Canada diversified. Institutions moved first. Headlines followed later. No one announced a bond collapse. Orders were simply canceled. Allocations were quietly changed. And Washington adjusted, not because it wanted to, but because it had to. Behind the scenes, the damage spread faster than public statements suggested. According to Bloomberg reporting from Davos sidelines, several European sovereign wealth managers halted participation in upcoming U.S. Treasury auctions altogether, not just trimming exposure, but refusing new issuance until Washington clarified tariff and alliance policy. That hesitation hit Scott Bessent directly because the Treasury's first quarter borrowing calendar already assumes heavy foreign participation to absorb expanding deficits. Howard Lutnick's comments compounded the problem. EU trade officials privately told the Financial Times that his speech confirmed their fear that America First now meant permanent extraction rather than partnership. The reaction wasn't symbolic. Internal EU memos, circulated after Christine Lagarde left the dinner, reportedly explored accelerating settlement infrastructure that bypasses U.S. intermediaries entirely, including expanded Euroclear usage for non-dollar instruments. Trump's Greenland remarks also triggered quiet concern inside NATO. Reuters reported that several member states questioned whether future security guarantees could be repurposed as bargaining chips, raising risk premiums across European defense financing. Those concerns fed directly into bond allocation decisions. At the same time, Chinese issuers moved quickly. State-linked firms increased preparation of new yuan bond offerings, anticipating stronger European demand if U.S. volatility continued. Bankers involved in the deals told the Wall Street Journal that orders were increasingly coming from pension funds previously restricted to dollar assets. Canada's response was watched closely. After Trump's warning to Mark Carney, Canadian officials reaffirmed diversification plans already underway, reinforcing Europe's sense that delay only increases exposure. None of this required an announcement. The pressure showed up in yields, canceled orders, and silent reallocations, markets enforcing discipline where diplomacy failed. The question now is not whether this continues, it is how fast.